Fund Supermart, your online gateway to unit trusts.
Thank you, Terence. Our next speaker is Mr. Ben Sheehan, Senior Product Specialist for Asian Equities at HSBC Global Asset Management. He joined HSBC in 2007 as a Senior Research Analyst and has about 15 years of industry experience under his belt. Together with him today is Mr. Dennis Chin, Senior Manager for Wholesale Business at HSBC Global Asset Management. It is my pleasure to invite them up on stage today to share with us HSBC's Asia ex-Japan smaller cap strategy. Ladies and gentlemen, Mr. Ben Sheehan and Mr. Dennis Chin.
Good morning, everyone. Before highlighting the exceptionally good opportunities we're seeing in Asia ex-Japan small caps, I just thought I'd share with you some thoughts, just given it's been a pretty horrible start to the year in terms of equity performance. Just in terms of HSBC Global Asset Management's view, we really see this more as a crisis of confidence rather than a crisis of fundamentals. And given that Asia ex-Japan GDP is more likely to be in the range of 5 to 6% moving forward, and developed markets are around 1 to 2%, Asia ex-Japan still, from a fundamental point of view, still is looking quite promising. The silver lining for investors at the moment is that valuations have now become extremely attractive. We're now at a situation where regional valuations are at or close to, or in some markets below, valuations we saw during the global financial crisis in 2008. So the volatility is concerning, and we probably do expect to see more of it. Progress doesn't happen in a straight line, but it is a pretty good entry point by long-term averages to get set for the long term in your Asian equity exposures. In terms of the catalysts moving forward, we do see quite a few tailwinds. Primarily, we still have fairly good monetary policy. We see good prospects for governments in terms of their structural and policy reform moving forward. But the key catalyst, I think, is valuations, and things could really, really take off. I'll get back on with my main game. I've had my rant about the economy. But moving on to the opportunities in Asia ex-Japan small cap, really this is just to show you the premium of returns you're receiving by going into small caps over large caps. The dark blue line is the large cap Asia ex-Japan returns over the about a 15-year period versus small cap. And as you can see, small caps have actually delivered a strong return. You do note that there have been periods of extreme drawdowns during 2008, but as you can see, since 2008, small caps have resumed their pattern of excess returns. Small companies are often viewed favourably as a bull market investment, and that they'll only go up when the markets are strong. But we actually beg to differ. If you look at the last 3 years between January 2013 and now, the broader Asia ex-Japan large cap market has actually delivered pretty much zero. In contrast, the performance of the HSBC GIF Asia ex-Japan Smaller Companies Fund has delivered in the range of 30 to 40% performance over and above the broader market. So this is not just a bear market proposition, a bull market proposition rather. Interestingly, we saw in 2015 Asia ex-Japan small caps outperformed Asia ex-Japan large caps by about 7%. I'm not sure if that comes as a surprise to you. It certainly came as a surprise to me. The large cap index actually performed minus 10% last year, and just looking at the index, small caps underperformed by only 3%. Our fund actually outperformed the index materially, so we actually produced positive returns. So we actually preserved capital and a little bit more during 2015. The returns I quoted were in US dollars, so not to confuse you with the Singapore dollar returns, which would be slightly different. This is probably the most important chart that I'll share with you today, just in terms of why the opportunities for active management, for managers such as HSBC to exploit Asia ex-Japan small caps. It's quite simply a very inefficient market. It's very under-researched, very misunderstood, very much ignored by the sell side. we have a situation where of the 8,000 stocks in Asia ex-Japan, only about 21% have any decent sell-side coverage. The other 80% have probably one or no brokers covering them. So what that basically means is that our research is original, our research is ahead of the street, and it enables us to find gems in the market. And most importantly, it's probably the single biggest determinant of the level of excess returns we've been able to deliver in this strategy over the last 3.5, 4 years. Now, part of the reason the opportunities in small caps are quite interesting is that the composition of the small cap market is very different from that of the large cap market. The large cap market is dominated by large banks and insurance companies, state-owned enterprises, conglomerates, whereas the small cap sector, which is denoted here in the light blue bars, is more balanced. It does include financials, but it has a much more bigger weight to new areas such as industrials, consumer discretionary, and consumer staples. And we're finding, as a general statement, that you're getting exposure to more new economy stocks in Asia ex-Japan. And we've got some very exciting opportunities to find very good growth companies in a low growth world. And that's something I really want to press. And I'll in some of the exciting investment themes that I'll show you later in the presentation, you'll see that there is good growth. It may be negative from a macro point of view, but we're buying companies, we're not buying markets. The first investment opportunity I want to tell you about is a very exciting one. It doesn't sound like a very exciting industry, but it is exciting as far as we're concerned. We've made a lot of money off it. Chinese textiles is a sector which has gone through intense consolidation and pain and suffering over the last 4 to 5 years. It's an industry that was oversupplied, overcapitalized, and effectively needed restructuring. So all the pain and suffering that's going on in the broader economy in China today in terms of the industrial capacity, the excess inventories, the oversupply, all these issues have actually already been dealt with in the textile industry. So whoever's left in the textile industry in China today is actually cleaning up to some extent and benefiting from that consolidation. So that's one of the reasons we like Chinese textile. The other big driver of returns moving forward is more of an outsourcing theme, whereby there's an increasing level of production that is moving to lower cost markets such as Vietnam, which is certainly on the rise as a manufacturing hub. We're not actually holding Vietnamese stocks, but we do hold names in the portfolio that's listed in Hong Kong and China that have exposure to Vietnam. We're also excited about textiles in India. Clearly, India has cost advantages, as is demonstrated here. Labour costs are much lower, but the story in India is much bigger than that. We've been able to identify some very good opportunities in India that are not only cost competitive, but are globally competitive. The company we're currently holding in the portfolio and has actually made us a lot of money. It's actually more than doubled in value in 2015, an example of growth in a low growth world. And it includes in the US customers such as JCPenney, Bed Bath & Beyond. It's also a big supplier to IKEA. And I didn't mention this, but it actually supplies towels and beds and linens, things like that. Fairly boring industries, but exciting investment returns. Now, the auto components theme is an exciting area for small caps as well. There's an increasing level of technological content that's going into cars these days. I was talking to a Singapore taxi driver this week who was quite fearful for his job, that he thinks in 5 years' time he's going to be replaced by a driverless car. And so it seems to be quite an issue that Singaporeans are acutely aware of. Whether or not we have driverless cars in 5 years' time, we'll have to wait and see. But one thing is for sure, we'll have an increasing level of computerization and driver assist, semiconductor componentry, circuit boards, sensors, and these are all features that the Asia small cap companies that we're holding in the portfolio are likely to exploit moving forward. So this is actually a theme we've had in the portfolio for a couple of years, and we were very early into this theme, but we think it has a lot further to go. as big companies such as Toyota announced fairly recently that they're actually likely to move into greater production in the future, research and development into driver assist and driverless cars as well. So the auto industry's actually started to grapple with a very complex issue and starting to get on board as well. Just on Vietnam again, this is just to highlight the rise of Vietnam as a manufacturing hub and data you may not be aware of. But Vietnam is rising in terms of its importance of trade with the US, for example. As you can see in the red line down the bottom here, from a very low base, it's risen very quickly to comprise about 12% of imports of apparel and textiles and about 16% of footwear going to the US. And that's really coming at the cost of China. China's still quite dominant, but Vietnam is definitely on the rise. Now, one of the reasons we're quite constructive on the prospects for Vietnam moving forward is the Trans-Pacific Partnership, which is a multilateral free trade agreement that is likely to be ratified this year, which involves several parties, including the US, Vietnam, but actually not China. China may get involved at a later stage. So this gives Vietnam a huge competitive advantage in terms of directing its sales, exports of its goods. It also has a free trade agreement with the European Union, which is also a tailwind. And again, we're playing this not through Vietnamese stocks at the moment, but through some offshore stocks that have exposure in Vietnam. Yeah. Another example of high growth in a low growth world is the alternative energy sector. China has gone from 0 to 100 in a very short space of time to be a leading alternative, or the leading alternative energy producer in the world, namely solar and wind. And this is something we've got exposure to through some of the Hong Kong listed names. One wind power turbine manufacturer is actually a key beneficiary of this policy directive. But it's not just about China's policy that's going to drive this theme moving forward. There's actually policies through governments all over the world. So now this wind turbine manufacturer, we expect most of its growth to come from not China, but actually from US to exports to the US. In particular, our company is actually going to be supplying turbines to General Electric, which is one of the leading wind generators manufacturers. Also exciting in terms of alternative energy, and another example of high growth in a low growth world is the prospects for alternative energy in India. Now, India has just come out with some very aggressive targets in terms of where it wants to be in terms of its alternative energy production. As you can see on the left-hand side, this is where India's wind and solar power generation is now, and in 7 years' time, this is where it wants to be. It has a lot of work to do. So it's going to involve a lot of investment, a lot of government policy support, but there's going to be clearly good opportunities for component manufacturers and people involved in the manufacturing food chain of solar and wind, and we're currently positioned to benefit from this growing trend. Now, interestingly, you might be thinking, well, what's the point of using renewable energies when fossil fuels are so cheap? Well, I think went below $30 again overnight. But despite this challenge in terms of competitiveness from fossil fuels, the policy directives, the momentum, if you like, towards renewable energies seems to be with us and here to stay. So cheap fuel will probably not disrupt the momentum and velocity of the push towards renewable energy. Finally, I just want to share with you another exciting theme. We are actually very bullish on Chinese property, and that may surprise you, but we're not bullish all around. China is not one property market. China is many property markets. And when we're conducting our analysis on China property in 2014, when we first took this position, we were very contrarian. We were first movers. And part of the reason is you look at the headlines in China that there's oversupply of housing, that there's ghost cities, empty apartments, inventory that'll take 3 to 5 years to resolve. And yes, that is the case in some smaller cities, in Tier 2, Tier 3 cities. But we did some drilling down on the numbers, and you can actually see that in Tier 1 cities, which is a blue dotted line at the top here, this shows price appreciation. We've actually had a price spike in the last 12 months. Prices in Tier 1 cities have actually raised around 17%. In Shenzhen in 2015, Shenzhen is a city across the border from Hong Kong, where I live, prices actually were raised, went up 40% in 2015. So this is not a market where there's a supply-demand it's a supply-demand imbalance, but the imbalance is on the supply side. There's simply too much demand. I had some of my colleagues go across to Shenzhen trying to snap up some Shenzhen apartments last year, only to find themselves waiting in a very, very long line across the street trying to talk to a sales agent. That never actually happened. So there's actually much better fundamentals in Tier 1 cities. Now we're playing this theme very selectively because you have to be very selective in China about which companies you're investing in, but we're focused on companies that are high quality, have very good balance sheets, and their land banks are primarily in Tier 1 cities, which have much better fundamentals than Tier 2 and Tier 3. Just a final word on valuations. I've been going on about it a bit, and I'm sorry if I'm sounding like a broken record, but here's a different angle. This is valuations broken down on a country-by-country basis. Now, this data is a little out of date because it's as of the end of November, and clearly we've got weaker markets since then, so the valuation levels are even more attractive. But basically what this shows you is the dotted bold line is the long-term average of price to book for the Chinese market, the Hong Kong market, the Taiwan market, and so on. And anything below the line is cheap, and anything above the line is expensive. As you can see, all the valuation as of the end of 2015 is cheap. It's at or below, or well below, long-term averages for valuations. So if you just compare Asia against itself, China against itself, Hong Kong against itself, it just represents a striking opportunity to get set for the long term. I'll leave it there, and thank you very much for your time.
Okay, hi, good morning to all. Okay, my name is Dennis Chin, and I am from the China sales team in HSBC Global Asset Management. Okay, following up on Ben's presentation, okay, I will share how you can gain access to the various opportunities that he just mentioned. Okay, so I would like to introduce our HSBC Asia ex-Japan Equity Smaller Companies Fund. Okay, our fund was actually launched in 1997, okay, even before I got enrolled for my national service. Okay, and ever since its inception, okay, the track record has been very consistent and established. Okay, the fund actually adopts a bottom-up fundamental approach. Okay, as earlier mentioned by Ben, only 21% of the small cap stocks are covered by analysts. So actually this creates a very attractive proposition for active fund managers. Okay, so therefore this strategy further re-emphasizes the expertise of the fund manager. Okay, and for this fund, we actually have 2 dedicated fund managers and 1 analyst. Okay, moving on. Okay, investing into small cap also allows you to participate in new and upcoming companies. Okay, just want to shed some light on the small cap definition. Okay, we are not actually looking at companies like penny stocks. Okay, rather we are looking at companies with a market capitalization of below $3 billion. Okay, and if you look at the SGX, only about 40 to 50 companies actually have a market capitalization of $2 billion and above. Okay, last but not least, okay, this fund has been recognized for its performance since 2013. Okay, as evidenced by the number of awards that you've seen on your screen. Okay, and in 2015, it actually won the following 2 awards. Okay, Best Fund over 3 years, Asia Pacific Small and Mid Cap. Okay, Best Equity Funds, Asia ex-Japan 3 years. Okay, and then let me move on to the next slide. Okay, which will demonstrate the fund performance. Okay, basically for the red bar, it indicates the performance before sales charge. Okay, for the gray bar, is the performance after sales charge. Okay, and for the black bar, is the benchmark performance. Okay, so we can see from the chart, okay, as earlier mentioned by Ben, 2015 was a very challenging year. Okay, however, you can see from the benchmark that the returns was minus 3.32%. Okay, however, the fund delivered a positive return of 0.65%. Okay, the fund has also consistently outperformed the benchmark over the 3 years and 5 years period. Okay, you can look from the 3 years performance, right? The fund actually delivered 5 times more than the benchmark returns. Okay, so as previously mentioned by Ben, okay, in spite of the current market volatility, okay, valuations in the Asia market has actually came down to a very attractive level. Okay, and just to summarize, small caps tend to outperform in the Asia ex-Japan region as compared to the large and mid caps. Okay, so if you are intending to invest into the Asia ex-Japan region, okay, you can seriously consider incorporating our fund into your portfolio. Okay, so with that, I end my presentation. If you have any further queries or questions, come and visit us at our booth. Thank you.